Hi, my name is Charles Hamey, Portfolio Manager at ClearBridge Investments. Today I will be discussing the key insights from our Global Infrastructure Quarterly Valuation Pack. There's a lot of material in the presentation, so please feel free to reach out for a copy. But for the purposes of today, I will focus on three key things. Firstly, I'll give you some context for the environment we're in. Then I'll provide an overview on valuations, focusing on listed valuation differences, then a brief outlook focusing on the risks. Firstly, a few comments on the context around this presentation. The fourth quarter of 2020 saw strong returns in both infrastructure and global equities. The market rose as two effective vaccines for COVID-19 and their subsequent approval for use raised expectations of a strong recovery in 2021. As it relates to infrastructure, the vaccine announcements raised hopes for high economic growth, as well as a return to travel for business and leisure, which lifted cyclical areas of the market and economically sensitive user pays infrastructure assets. Renewables continued their strong performance and energy rebounded. At the same time, stimulus remained front and center. The EU approved a $1.8 trillion stimulus plan and agreed to far more aggressive cuts in greenhouse gas emissions over the next decade. The US also passed another stimulus package with more to come. However, we did see hard economic data showing signs of slowing as unemployment levels remain elevated, albeit this has been softened by strong government stimulus, continued job support programs, and really accommodative monetary policy. Perhaps most importantly in the quarter, though, we saw political uncertainty reduce as Joe Biden won the race for the US president and will govern with a small majority in Congress and the Senate. The lack of an overwhelming Democratic mandate does reduce the near-term risk of structurally higher taxes and more stringent regulation. But we do think that Biden leads to some very interesting developments, especially true on a topic like renewable energy and infrastructure that really hasn't seen much movement in the US over the last 4 years. His $1 trillion plan to net zero focuses on developing modern, sustainable infrastructure with a strong emphasis on renewable energy and electrifying grids. He's also hinted at modernizing highways and roads, investing in light rail networks, updating ports, and investing in 5G technology, amongst other goals. Most importantly, these proposed efforts have long been the goal of many Democratic leaders and Republicans, so we think it's highly likely that it will get passed in some capacity. With that context, the key takeaways are we're seeing divergences based on fundamentals, and we expect that to continue. It's really becoming a stock picker's market, and we're very happy about that. And valuations remain attractive. In the infrastructure space, challenges continue with the second wave of infections impacting mobility, and more recent mobility restrictions, especially in Europe, have impacted the visibility of cash flows for road and rail stocks. But in particular, the outlook for airport traffic remains very opaque. What I would say though is EV to EBITDA multiples and dividend yields are misleading for infrastructure stocks at the moment due to the significant but very short-term reductions in earnings and dividend, which make them appear expensive. But they are very long duration assets. So whilst the short-term risks are real and have been reflected in the share prices, they don't temper the long-term attractiveness of these assets. Utilities, on the other hand, have had minimal impact from the pandemic and is a sector we do feel bullish about for 2021. They're an essential service with supportive regulation and are at the forefront of the decarbonisation of economies. So they should see strong asset-based growth, earnings and cash flows and dividend growth in the medium to long term. So to be clear, valuations do remain attractive on a medium to long-term excess return basis. Slide 20 shows that multiples have recovered. But as I noted earlier, the numbers have been distorted by infrastructure. Airports in particular, earnings are way down, so the numbers aren't really accurate. So on a multiple basis, they look expensive, but on a long-term expected return basis, the whole user pays sector, toll roads, rails, and airports, is really looking like great value at the moment. Airports in particular, our decision not to go to much larger weights is a function that for airports, there is a lot of potential structural uncertainties related to air travel. So something to watch, but perhaps at this point, captured in the share prices. Communication assets have been very resilient, not surprisingly, given the huge capex required for telcos as we roll into 5G. On slide 22, you can see that generally utilities are trading at very attractive multiples and well within historical ranges. Electric utilities in particular are very safe with strong dividends, good rate-based growth, and strong allowed returns, and have become a core part of our portfolio. Renewables are now trading on a much lower cost of capital, so naturally higher multiples, which isn't surprising given these companies are beneficiaries of the clean energy transition globally. The weighted average contract duration of these companies is around 20 years, so we have high certainty of cash flow and valuation. And the consistent theme across all these companies is that they have strong competitive advantages, very long contract duration, as I mentioned, international scale and strong capital allocation. And this has been reflected in really strong financial positions and very resilient revenues and dividends. What is clear is that the current market does require active management, and we have seen and taken advantage of some great opportunities, whether it's high quality infrastructure assets like roads and airports, or the structural growth of utilities and tower assets. There's some great opportunities out there. I wanted to touch upon a question we get asked many times, and that's regarding the valuation differences between listed and unlisted infrastructure. What we have seen is unlisted transaction multiples consistently being higher than listed multiples for some time. This is evident across most sectors, but let's use UK Water as an example. In the past 10 years, the listed UK water companies have traded from a 5% discount to as much as a 25% premium to their regulated asset base, whilst most private transactions have occurred closer to a 30% premium to asset base. This has created many opportunities for listed market investors to gain exposure to most sectors in our universe at significantly more attractive entry prices. Think about it, when you have this difference in valuations, there's two likely outcomes. First, the company performs broadly in line with its peers, and given the lower entry price, investors will earn a higher return on their investment than they would have with similar unlisted assets. Second, the company is taken private by unlisted funds at an attractive exit multiple, and there's been numerous examples of this in the past few years. Either way, over the long term, holders of the listed stock are likely to generate better risk-return outcomes than their unlisted counterparts. This is almost entirely the result of the more favorable entry price. So that gives us comfort that the valuation signals we're seeing now for listed assets are very compelling. So with that in mind, nothing looks expensive. Generally, most sectors are at fair value, but we note we are running very conservative numbers through our models. Just quickly now focusing on some of the risks. Most of the important drivers we see are very stock specific. So at the company level, we're closely focused on asset-based growth, operational performance, regulatory outcomes. As it relates to those risks, we are very comfortable. Certainly consistent across all our companies is just how strong their asset-based growth is. And that is the ultimate driver of portfolio outcomes. More generally, like all asset managers, the more tactical risks around inflation, interest rates, and growth are important to focus on. Out of those risks, the one which most uncertain about is the inflation outcomes. This, in fact, has the least portfolio impact on infrastructure assets, given the assets we invest in are essential services with low elasticity of demand, where inflation is passed through to the user of that asset, so it doesn't impact the fundamental value of that asset. So with that, let me wrap up by saying we remain very confident in the total return outcomes of the sector going forward. Thank you so much for listening, and if you would like any more information, please reach out to your sales representative. Thank you.